Hey, everybody. Welcome to Get Smart. My name is Gareth Soloway here at verifiedinvesting.com. And today is a special edition here of education and analysis. And the goal here today is to really get this period where the stock market is closed. Granted, crypto and some futures and commodities are open, but it's not as busy. So what we're going to do today is we're going to spend a lot of time with some Q&A, answering a lot of your questions. The goal is to use a day where the stock market is closed to up our educational prowess, right? So always be learning, always be improving, so that when the stock market opens tomorrow or when the crypto markets get crazy, we can dominate and make more money, right? Always improving. And I want to be clear, folks, is that I have traded now for I'm in my 26th year of trading, and every single day I am trying to continue to learn, and I am learning, right? Every day the markets are a little different. I'm adjusting my analysis and adjusting to get better. And so I want to be clear on that. You never reach the zenith of your educational potential. You always have to be striving to do better. And if that's the key to just being a more profitable investor and trader. So I want to introduce Lawton over here. How you doing, buddy?
What's going on, guys? How's it going? I'm going to be your host, reading out questions for you guys to answer. And again, guys, you can go ahead and leave your questions in the question box on the side. If your question doesn't get answered, and I know there's a lot of questions, I'm going to be going live later to answer any remaining questions that weren't necessarily answered.
Yeah, and I'll just say this, is that, so Lawton's the junior trader here. We have a program where we're bringing in new junior traders. So if you're ever interested and you want to dedicate yourself to learning how to trade, we always have the potential for open spots. So that's very exciting as well. And I just want to say, Lawton, man, you've done amazingly well. He's batting basically 80% in the Apex Live Day Trading Room. That's 4 out of every 5 are winners. So great job, man. And let's kick it off with some Q&A.
Yeah, thanks for the kind words. All right, let's get started. Peter Yanev says, I've been following your page for 4 months now. I haven't missed a morning yet. My question is, at what point do you stop respecting a trend line? Does it ever lose its importance regardless of how many times it's been pierced?
Yeah, it's a great question, right? So the answer is there is a point where a trend line goes from being a major trend line to a minor trend line. And then from a minor, it can actually be essentially negated to the point where you stop paying attention to it. And I want to go over that now. So what we're going to do is we're going to flip over to some charts. This is the Bitcoin chart up here. Now you can see right here that as of now, these would be major trend lines, right? So again, talking about major versus minor first. Major is a line that is being continually respected time and time again. So you can see on Bitcoin here, over here, this orange line got hit here, 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 and here, right? So what this tells me as a technical trader is that this baseline at around 92,000 is a significant major support level. What it also tells me is that if it ever breaks, that would be where you would assume it would be a major breakdown. So major trend lines, when you get a break of them, whether it's a breakout or a breakdown, those are major moves. Now, what makes a major trend line go to become a minor trend line? So if by chance you kind of come down like this and you trade a little bit below and then it recaptured, think about it like this. If you guys, we all know Swiss cheese, right? Swiss cheese with the holes in it. So essentially what happens when you chop through a trend line a lot of times and you come back above and then you come back below, the more you do that, the more holes, or essentially the more action can go through it, right? The weaker it becomes. And that's when you start to say, okay, hey, listen, this trend line broke here, but then it recaptured. That's the market. That's the charts telling you that it is now a minor level and should not be treated as such a significant trend line. Now, lastly, what I would just say is that at a certain point, you get a lot of action up, you get a lot of action down. At a certain point, you have to say, okay, it's too minor to really be of importance. And so really what you're looking for is you want to focus as a trader. And this is what I do. I focus on the major trend lines. Those are the ones that I know if they're broken, it should be a significant move in one direction or the other. And it's also the ones that will be major support, where you can say until it's broken, expect bounces off this line, and then major resistance, where if price goes up, you get a rejection right there. All right, hope that answers your question. Let's kick it back to Lawton for another one.
All right, next question comes from John Weinhofer. John asks, what screeners do you use to identify stocks that are in play?
That's a good question. So I'm going to give you guys my routine for in the mornings, right? So I wake up, I usually grab my phone off the side table and I start to scan my watch list, which really compiles mostly the large caps. But in all fairness, I have Rigetti on there. I have, a lot of the things that have been very active as a technical trader. I always want to be keeping an eye on. Now, again, do I have micro caps or penny stocks? No, because again, I don't trade those. They tend to be thinner or less predictable. Now, as a technical trader, if a stock is getting pumped on Wall Street bets, it's more likely to essentially not adhere to the technical levels because it's being pumped and it's getting, pushed by an outside source. So what I want to do is I want to be aware of those type of stocks, usually you kind of push them to the side. Now, Rigetti was this early on. That's why it had that incredible move to the upside. But essentially, over time, it starts to adhere as it's not getting pumped as much to the technicals of the chart. So that can start to come back into play. All right, I throw on CNBC. Now, I don't turn on CNBC because I'm interested in what analysts they have on and their biases. I'm a technician, so I care about the charts. But what it does do is it shows me the ticker at the bottom of the screen that shows me big movers, right? If it has a lot of pre-market volume and it's up or down a lot, I'm like, oh, look, Disney today is down 8% on the day, or Nike's up 5% or something like that. That's abnormal to me. I also have a scanner that picks up the biggest gainers and the losers and also the most actives, all right? So again, I'm looking for NVIDIA that might be up or down 5%. That would be something I would trade, or a smaller stock that could be up 20, 30, 40% or down 20, 30, 40%, as long as it still fits usually a 5 billion to 10 billion at minimum market cap. So again, those are the basics of it. I don't use any kind of high-tech crazy screeners at this point to pull out things. We are working on an AI that will assist us in trading and give trade alerts out to us as well. That's coming. We have a beta version that we're testing at this point. But aside from that, I keep it simple. I want to know what's moving, what has volume, and what's a mid to large cap trading opportunity. And then I go right to the charts and start analyzing them.
Cool. All right. Next question comes from Rick Hedges. Rick says, how do you determine sizing when doing a deal or a trade? For example, about 2 weeks ago, you called out RL as a short and it worked out great, but I wish I had committed more.
That's a great point. So the key is this, is that number one, you have to be very aware of your own financial risks and tolerances. And so you have to look at a trade. I mean, there's always ones where I look back and I'm like, man, if only I'd gone all in. But the problem is, if you go all in, it might be the one that doesn't work out. And I will be the first to say is that I have many trades that don't work out. I just happen to have many more that do. But there's always the one lurking. In fact, it was interesting. I was just saying this to my head trader out there, Ben, and Drew, one of my elite traders out there as well, is that so far in the Apex Live day trading room, I've batted 100% this month, right? So I don't know how many trades I've done, maybe 15 day trades this month or whatever it is. But I said to them, I said, guys, all right, I know my loser's coming. So you start to kind of be like, okay, this is not normal to have this type of streak. So one of these next probably few trades that I'll take won't work out. It's just because it's a probability game. It has nothing to do with me being great. The greatness is that I can bat 80% or better consistently. But again, 80% still leaves 2 trades out of every 10 that are going to go against me. So those are the first things. The second thing is, always go on the conservative side. But what I like to do is I like to say, okay, is this a large cap stock? If it's a large cap, what's the biggest drawdown that I could expect in a crazy scenario? And then I calculate that in my brain and I say, okay, I have to figure out what share size where if I get that drawdown, I can still maneuver in that trade and I'm okay with. Because if you go too heavy, what ends up happening is emotion kicks in, right? So you see, let's say you go too heavy on even something like Apple, because again, you were sure it was going to be a winner. You picked it up. You were expecting to get $1 bounce on it as a trade. And instead it goes down $1. Instead of being able to maneuver, you're panicking and you're saying, oh my gosh, I'm down, 10,000 on this trade. I really only thought I would risk maybe 1,000. And here I am. You can stop out of it. But the point being is that your emotion takes over. And once emotion takes over as a trader, you're done. The market owns you. It literally will control you. So what I would say to you in terms of Ralph Lauren, in terms of that call, is start looking and saying, all right, look at the facts. What market cap was Ralph Lauren? How much was it down on the day? What was the potential drawdown or pop that I could have experienced in the opposite direction? And start to kind of formulate a thesis for why or what share size would be appropriate also taking into account your risk tolerance, right? So what's your drawdown where you start to panic? Is it just $500 of a loss, or is it $1,000? And notice how I'm focusing on the loss here. I'm not focusing on the gain. The gain will come. If you're an 80% trader, gains will come. It's not getting yourself into a position where the emotion takes over. And I always would rather err on the side of caution and win 80% of the time by betting less, but just being consistent versus getting in all in. And then one of those, losses ultimately wipes out a 10 months or 6 months of my gains. All right.
All right. Next question comes from Prag. Prag says, with all the different subscription packages offered by VI, how do I know which one is best suited for my needs?
Yeah, great question. So real quick here, guys, and in fact, what I'm going to do here is I want to just show you what we have done. So bear with me as I just bring up our homepage behind me. But essentially, here, let me unfreeze this so you can see. So we've actually consolidated to basically just have 3 services now. Now, technically 4 or 5 because we have the live trading room, but that's for day traders. So if you're on the live trading room, then that one is going to be, this is day trading, right? So again, a lot of you guys, if you have to work 9 to 5, it may not be feasible for you to be a day trader. That's totally understandable. But in terms of the swing trades, we have a service right here, which basically gives you 3 options, right? It's smart money stocks, smart money crypto, and smart money commodities and miners. And the beauty of this is we've rolled in all of our other stuff into these services so that if you're into stocks and ETFs, it's a one-stop shop, right? So you have swing trader, which is me. So this is the swing trades that I did in this service prior. But then I said to my guys here, we talked about it and said, but we got to give more value. I want people to have a subscription where it's a one-stop shop, where it covers not just swing trades, but every angle. And so Ben, my head trader, he launched the ETF trader. All right, so that's included in this subscription, which is really cool, actually, to think about that you also get this new service included at the same price, by the way. And Ben's trading ETFs, so he's only trading ETFs and he's only going long. Now, he might end up shorting the market, but he will use an ETF to go long to do that. And so people that, let's say, they don't want to do the individual stocks, they don't want those things, then you can focus on the ETFs. And then again, we said, all right, well, what about retirement? What about investing smart for gains? Well, Dr. B launched the dividend trader. This is focusing on a longer term portfolio of high dividend plays, which will still be exited occasionally when they get too lofty in price. But the goal is to buy stocks that are quality at low levels that pay a dividend. And then when they go up incredibly, you take profits overall as well. And as if that's not enough, but wait, there's more. But lastly, guys, or a couple more here, the small cap catalyst by elite trader Drew. He's finding the small caps that are going to be the next big runners, the ones that he thinks. He's building a portfolio of these. Again, these are higher risk plays, but amazing opportunities. I always talk to him about my ideas as well. We have Earnings Trader Live, which again is day trading earnings action. So NVIDIA coming up, that'll be in there. And then the Q&A once a month. All members get to come in and ask questions to the pro traders here. And so the idea is I know before we had a lot of different options. Earnings Trader was its own service. These other things were the own services. We merged them together. So it's really just 3 options. Do you want to swing trade stocks? Okay, well, you get everything here. Do you want to swing trade crypto? Then you get everything under the crypto tag. And there's multiple services. We have the hodler under there. We have the altcoin edge, which is just altcoins, etc. And then commodities. We have hard, soft commodities, and then ETFs and stocks within the commodity service. So really just to suffice and to summarize, the idea here is to give more, but make it simpler. And I think that's what we've done.
Cool. Great explanation. All right. Shahirar, excuse me for butchering your name, says, I want to know from our master trader how safe day trading cryptocurrency is. Do you think it will be smart enough to day trade every day or wait for the big moves before taking any trade setups?
That's a great question. So by the way, in the smart money crypto, we do have a little day trading in there as well. And by the way, you could just see right here, this is a chart of Solana. And as long as we're talking crypto, I'll go over Solana's chart. Look at this move. Here's your support line. Look at how it's hovering and starting to break down. This to me looks like a bear flag, right? So my guess is Solana's heading down to the 160 level in the not too distant future. But that's neither here nor there. The point being is that day trading in general, it is if done correctly, I find it to be lower risk than swing trading because you don't have the risk of something happening in the overnight, like a war breaking out or some crazy comments or something happening in China, right? But at the same time, the risks to day trading are more emotional. So because as a day trader, you're watching your screen and you're trying to net small or mid-sized gains in, let's say, seconds or minutes, basically a day trader goes a little heavier on those positions, which means that if you're not accustomed to the P&L jumping up and down hundreds of dollars in a second or two, it is going to create that negative impact of emotion. And so what I always say is, like, no one should go into day trading until you essentially have learned the methodology, to learn the charts, how to analyze charts, and feel comfortable enough to be able to trust the charts. And the other thing too is you always have to have an exit plan. So you have to go into a day trade saying, okay, well, if X happens, then I need to cut that. And a day trader could have multiple losses in a day, but the goal is to have more gains than losses. So basically it's taking what you do on a swing trade basis and shrinking it down to a tiny time frame. But again, the emotion tends to go much higher because, listen, if you're in a swing trade and it's down for a day, you're like, all right, well, I still like it, so it's going to go up in the next week or two. No big deal. Day trading, it's a little trickier, right? You're literally looking at seconds to minutes of price action and capturing it. So the charts work perfectly. Well, listen, nothing's perfect, right? But the charts can be read the same way as you do on a swing trade. It's just that ultimately, it's in a tiny time frame, very fast paced. And again, it is not for everyone, and it does carry a lot of risks.
Cool. All right. Aaron is asking, can you please analyze the Celsius chart, CELH, Celsius holding? We know it's due for a bounce, but at what point might we see that?
Yeah, so Celsius has been one that I've liked since it was probably in its mid to high 20s here. If we take a look at Celsius, you can see, again, it's just been continuing to go down. The one positive is, and you can see the candle on I think this was last Thursday. Let me zoom in on it here. But the last Thursday candle was the first sign of positivity that I've seen in the charts here. And the idea being here is that essentially we got what we call a reversal candle right here. So that nice big green candle after kind of this grind lower. Now it did open higher on Friday and come back in a little bit, but now you have a bottom to trade against, right? So this now, let me get rid of those other lines. This now becomes a level to watch because of that reversal engulfing candle. So that's a positive on it. Having said that, to me, this is an interesting company because there was an overabundance of supply or inventory bought by Pepsi. Pepsi's their main distributor. And so what's happened is that Pepsi has not bought as much inventory over the last couple quarters because they had so much in inventory. The idea is if Pepsi has now ground that down and they start buying again, that should be a positive catalyst for the stock to go up. And then just looking at the chart, these are the types of charts that I tend to like. It's a profitable company. It's trading at levels on the charts that we're coming back to this area here. Oh, I apologize. Thank you. So if we go right here, you can see this area of support. So again, stock is down while the stock market is near its highs. Right? We have this area of support right here. Now, listen, is there anything that says it can't break this orange line and go down to these lows? No, it could. It could. So again, this would be one of those where as a swing trade, you leave yourself the opportunity to maybe add down in this lower range as well. But I like charts. It's a profitable company, basically no debt, down from $100 in a straight line, almost down here. To me, these are the ones that on a swing basis, I'm more interested in than something that's gone like this that's at all-time highs, right? I can't chase that. I've missed that trade, and I miss a ton of trades. What I want to find is what's out of favor that is a quality name, that's profitable, that, again, could have an upcoming catalyst. And I do think Celsius has that, and I do think it is at support here. But always remember, there's always a chance a stock could go lower than you think, and many do will go lower than I think. And so as a trader, as a swing trader, I want to be prepping and say, okay, I think it'll hold here, but if not, how do I react if it goes down to here? All right?
Okay, next question. David asks, do you add to a trade if it ever goes your way?
That's great. That's a great question. So a lot of people do that. And in fairness, that's fine. I don't like it, and I'm going to tell you why, right? So if we just look at a basic scenario here, let's say I buy at $10, right? And I buy, let's say a 1/10 position, right? So it's only a small position of what I'm willing to accumulate on a swing trade, but I buy at 10. Now, let's say that stock goes up to $15, and a lot of people would say, wow, it's starting to run, it's had a great move. I look at this and I say, wait, if I add another 1/10 to at 15, what is my dollar cost average? Am I in a better position in a stock or a worse position in a stock? Now, listen, there's a difference here. I'm a swing trader. In swing trading, I don't add when a stock is going in the money because it puts me in a worse position. What's the average price now? 12.5, right? $12.5. So now I have a 25% worse entry than I did before. Now, if you're a long-term investor and your time horizon is like 20 years, well, then who cares, right? I mean, stocks generally trend up over time. So it doesn't matter if you're adding, if you're adding every single month, no matter the price, I don't think that matters. As a swing trader, you don't want to hurt your average. Your average price is key. And you got to say, okay, I was right on this entry. I gave myself room to add. If I wasn't right, it's running. Maybe you let it go to 20. But again, I myself do not add there because, again, it just puts you in a worse position. What if you have an average now of 12.5 and it goes back to $10? All of a sudden, you're just back to your first entry, but now you're now down significantly on that trade. So for swing trading, I don't like adding in the money. I think, again, for me at least, that's a bad policy. Long-term investing is a lot different. Okay? All right, buddy.
All right, guys, we're going to take a quick commercial break, and we're going to talk to you a little bit about our smart money stocks and ETFs service.
Hey folks, welcome to Smart Money Stocks and ETFs. This service levels the playing field for retail investors, giving trade signals, insights, and data that institutions usually pay millions a year to receive. Members gain access to an unprecedented world of knowledge and trading and investing action. The service has multiple sub-services included that cover every style of investor. Members get the swing trader, focusing on swing trades both long and short, the dividend trader, focusing on investors looking at retirement and wealth building, the ETF trader for those looking to only go long but gain exposure on the short side via ETFs when needed, the small cap trader for those looking to find the next big small cap runners and emerging technology trades, and lastly, the earnings trader with live day trading sessions held when big earnings are being released. This is meant to give a taste of day trading to members as the traders will be trading live before your eyes. Smart Money Stocks and ETFs is run by myself and my elite traders. I have personally handpicked these traders for both their trading and investing ability and their knowledge and expertise. Please watch the videos below to get more insights on each part of Smart Money Stocks and ETFs.
Hey guys, welcome back to Get Smart. Let's hop into more questions. Let me take a look here and look for a good one. Okay, so Chuck asks, how do you determine the length of a time you place on your swing trades? Oh, by the way, I'm joined by Benjamin Poole.
Hey guys, how's it going?
And he is part of the Smart Money Stocks and ETFs service, as well as every other service pretty much.
That's right.
So how do you determine the length of time you place on your swing trade?
So it really depends. That's a great question. It depends on your overall time horizon. Gareth was just talking about the length of time that you plan on holding a stock. And ultimately, that's going to be the determinant factor on whether or not you hold longer term or not, right? Let's take NVIDIA, for example. If you think that in the next 3 years it's going to go higher, now that's more of a long-term play. But if you think that it's going to go from $120, $130 all the way up to $300, well, that is an opportunity for you for 100% growth on that particular stock, right? Or more. Now, if you're swing trading it and you want to just play the little bounces here and there, the best thing to do is figure out the support and resistance levels and then determine, okay, I'm in it at this level. I've taken a 10 to 15% gain on this stock. Is this enough for me? And then expect a pullback. So if 15%, all right, awesome. I'm going to go ahead and pocket that money. And then if it retraces, then you can re-add to it. Or you can wait for a resistance level. And at that point, not only do you cut it off the table, you can actually swing short that. And so then you can play the markets, whether you're in a bear market or a bull market, because the support and resistance levels are going to be very key. So it really depends on your current situation and how much you're looking to take on that particular stock. Celsius was up there. If you take 15% on Celsius, I mean, that thing is, it's at the lows of the chart, right? It's down over 75% from its all-time highs, even more than that. So you could look for maybe a little bit more, but just know that it's because it's so low, after it makes that run, like if you cut it at 20%, it could also then continue to drop even lower than your first entry. So again, it really depends on you. 10, 15, 20% is usually the target you're looking for. And so I would stick with that if it was me.
Cool. All right, next question, and this is a great one. Paul M says, trading is a competition between traders. Going forward, when the bear market comes, won't trading become more difficult as some of the new traders that came into the market over the past few years get discouraged and leave the market?
Day trading will actually become easier. The reason that I say that is the support and resistance levels will generally hit and they'll play out because the majority of the people who are in it are institutions. There will be a lot more fear and greed going on in the markets, which will increase the volatility. And that, as traders, is what we look for as the number one factor for entering or exiting a trade. If a stock is grinding down slowly because the institutions and the retail investors are just a little bit scared of that, we as day traders don't have an advantage. Where we have the advantage is when there's panic in the streets. When the stock market or when the stock is just continuing to plummet, then it'll hit those support resists or the support levels, and that is your opportunity to buy. And so it seems as if it would get more difficult, but there's going to be a lot more fear and greed in the markets, which means that it's much more ripe for opportunities. So, yeah.
Cool. All right, next question. Salome says, I'm thinking about trying out the day trading room. Can I do this just on my phone or iPad or my regular broker like I do with swing trades? Or must I have a much faster setup before I try the day trading room with you guys? Yeah, I can go ahead and answer that, Salome. It's important that you're able to execute our trades timely, right? So you should have your broker up, and we definitely recommend doing this on your computer. Not that you can't do it on your phone, but because we're looking at moves that might take minutes to play out, and sometimes even seconds if we're lucky, your order execution is extremely important. So it's important that you can get in and out quickly. Anything you want to add, Ben?
Yeah, so one of our traders in here, Drew, actually trades on his phone. He has all of his setups on TradingView, and he looks at all the support and resistance levels. He knows his levels he's going to get in, but he's so familiar with the platform on his phone that he will enter the trades and exit the trades on his phone because he is so familiar with it. So whatever you're familiar with, I would say stick with that. Slowly implement the trading platforms on a laptop or a desktop, but stick with what you know and at least have that as a backup, right? So you know you can get in and out of the trade. So yeah, absolutely possible, 100%.
Okay, next question. John W. says, Wolf had a nice move recently, looking like a breakout at the top of the angle, I believe it says, question mark, handle.
Okay, so yes, let me go ahead and zoom in on this chart for you guys. So Wolf this has been actually a pretty tricky trade, right? It's had a huge run. It made this huge run right here where it gained like 50, 60%. And then all of a sudden it dropped, traded sideways, put in this nice bull flag. And now it is starting to move higher. Now, just because it's at the top end of this parallel channel, it looks like it's about to break out, doesn't mean that it's going to. So what you're waiting for is a break above here and then a confirmation. So what that means is you want to close above. Here, let me go ahead and freeze this. You want to close above this parallel channel, basically this handle pattern, and then you want to close above the highest point of that previous candle. All right. So at that point, we have confirmation. Now, all of a sudden, okay, so now people are seeing this. Now there's a potential breakout. If you're not in the trade, I would wait for a pullback all the way back down to the top end of this parallel channel. And that's where you go long. So without that, this is so you got third hit of this parallel channel. And so probabilities actually dictate that it's going to pull back. So I would look for a retrace probably to the midline of this parallel channel. At that point, you're going to get in about $5.25, and then you could look to go long there as well. So although it does look like it's breaking out, kind of hold off a little bit because there's no guarantees in trading, and you want to make sure that it confirms above before you make any decisions.
Cool. Thank you so much for that question. Next question comes from Carl. And Ben, tell me if you need some time to rest. I know these are kind of quick. But Carl says, as a professional day trader, do you or should we amateur day traders have a profit goal for a trading year? For example, I realize that having an unrealistic goal may make you take on too much risk, but having no goal at all seems wrong too.
All right. So when I get into day trading, it really depends on what you're looking at as a potential stock. So for example, in the live day trading room, we look for as close to half a percentage, anywhere between 0.25% and 0.5% or more for each trade. And that's for the overall profit of a portfolio. So we're not looking for home runs. We're looking for singles and doubles. And so if you have $1 million account, you're looking at $2,500 to $5,000. So you're adding that much money to your account every single time you trade. So again, that's about 0.25% to 0.5% of your overall portfolio per trade. If you do that, you're going to stack the little wins over and over and over again. And then over the long run, if you do that consistently, then your portfolio is going to grow probably around 100%, depending on how many trades you take per month, right? So that would be my goal. If you can start with a smaller portfolio or a smaller position size, start to dollar cost average into the position as it goes against you. Maybe you can take a little bit more, but overall, that's our goal and our target.
Cool. All right, we this is a pretty common question. Kelly's saying, if I sign up for the day trading service and traded in my IRA, how can I go short in trades if my brokerage does not allow me to short in my IRA and only permits going long?
A great question. When we get into certain trades, like the SPY, let's say we're going to go short the SPY, there are inverse ETFs. So what you do is actually you look for the chart that is going to go long when we go short. And so a good example of that is the SDS. When we're getting into the SDS, you're going to go long the SDS, but short the spiders. And so there are a lot of ETFs, like Tesla has an ETF that's inverse of the up move of Tesla. So if we're going long, you get into that Tesla short. When we're shorting Tesla, there's a long ETF. And so you would just do that. And when you're doing that, you have to make sure that you're in those trades or you know those ETFs ahead of time, right? Because once we get into those trades, and you're going to go ahead and search for those, it might be too late. And so have those ready for you so that way you can take advantage of the shorts. So look for the inverse ETF.
Cool. All right. Thanks for that question. Let's see here. Looking for a good one. People are asking about the RSI. I know that that's really complicated to get into, but Ben is a pro at the RSI. Take a look here. Okay. Let's see. Beat says, I've been listening to you guys for 9 months and have studied the Winning Trader series over the last 5 months, then built my Excel spreadsheet. I've been started trading in November 24th. Currently booked 13 trades at $3,400. Amazing. So they're asking, my platform has a sell short option and the other is a stop limit options and trailing stop. What are the differences between those things? Thank you guys. You guys are awesome.
Okay, so a trailing stop is there's a couple ways you can do a trailing stop. You can either set it up by dollar amount, or you can set it up by percentage of loss. So let's say you're shorting a stock. Let's say you're shorting Celsius, right? And it starts to go into the money. So your average is right here at 625. So what you do is you'd put a trailing stop, meaning that if it goes back up 25 cents, if you set that as your target for your loss, then it would stop out as soon as it comes back up 25 cents. Now, if it never reaches that and it gets down to $5 before it bounces up to 5.25, then this trailing stop will continually move down until this heads back up and hits your stop. So that's what a trailing stop is it'll continually trail the move that you're looking for. So if you're going short, it'll trail it on the way down without you having to think about it. If you're going long, it'll do the exact opposite and it'll trail the stop up automatically, right? So that's what that is. A limit is, let's say that you're going long and your average price is $6 and you put a stop limit here. Stock moves up to $6.50 and you put a stop limit at $6. If that price of the stock goes back down to $6 and hits that level, it will stop you out. I will caveat that with, if price never hits that $6, if there's never a bid at $6 and it goes down to $5.99, you could actually still be in that trade as it continues down. So stop limits are good, but it does not guarantee that you're going to get out of the trade. It has to hit that or you'll stay in it. A stop order, as soon as it pierces that level, even if it hits $6 or $5.90, it will stop you out. You just don't get the exact price. So that's how those work.
Okay, one more question for you, Ben.
Okay.
So Brian is saying, what advice would you give to someone just starting out for trading? What is the most important lesson you have learned while trading?
Most important lesson, start small and focus on the things that you already know, right? Adding more things to your repertoire actually can make you a worse trader. So focus on the things you know, focus on the things that make you successful, hone in on those and become an expert at the things you already know.
Cool. Thank you so much. All right, guys, we're going to take another quick intermission. This time we're going to talk to you about our smart money crypto services and how much we've added to it recently.
Hey folks, welcome to Smart Money Crypto, a service that gives data and technical analysis driven swing trade signals and institutional level insights. Too many investors are influenced by social media hype or the latest pump and dump rug pulls. Here at Smart Money Crypto, we look for high probability setups both on the buy side and the sell short side for serious investors and swing traders. Smart Money Crypto includes the Mega Cap Maestro led by myself. I give trade alerts focusing on the top 50 cryptocurrencies by market cap. These signals are found using technical analysis techniques developed over my nearly 3 decades of trading experience. In addition, I do daily analysis videos. Members also gain access to Altcoin Edge, led by my head trader, Benjamin Poole. He will focus on the altcoins in the top 100 by market cap, giving exact entry and exit signals. Another offering that caters to the long-term investor in crypto is the hodler, headed by my elite trader, Drew Dosek. He will be building and managing a portfolio of signals meant for the long term. Lastly, all the verified pro traders will participate in Trader's Edge Crypto. This service caters to the day trader. With up to 2 one-hour sessions a week, investors and traders will be able to see the pros charts live, hear them live, ask questions live, and witness day trading, entry, and exits. Step into the world of crypto like you have never experienced before. Sign up and gain access to Smart Money Crypto.
All right, guys, and we are back. Joining me is the very handsome, you love him, you know him, Drew Dosek.
Hey, guys. What's up? How you doing? And thank you for that intro, Lawton. Very nice and generous of you.
All right. let's move on, get back into it. Next question. All right, Jason asks, why are the non-tech companies like airlines, food, and beverage companies going up exponentially? Doesn't make sense. Is the bubble going to pop?
Yeah, that's, good question. Who knows? And bubbles can go on for a long time. And airlines, if you look at them, look at the Jets, JETS, that ETF does track airlines. Certain airlines have been just going up exponentially, including UAL. But we all know things don't go up forever and things don't go down forever too. And so everything eventually balances out. Folks take profit. And so eventually those are going to come in too. Stuff just can't run forever.
Yeah. Okay. Thank you for that answer. Somebody's asking now. So Brent says, hi guys, what does your computer setup look like when you're on vacation? I currently use 2 laptops and it's just not enough.
Yeah, I feel your pain. Whenever I'm out of the office too, we're always yearning for more screens, right? And so whenever you're moving and say traveling like you're doing, if you do have 2 screens, that's fantastic. I heard Ben mention earlier, I do like to trade on my phone. So in essence, that is a 3rd screen for me. Ideally, when I'm at the office, I want to have at least 3 screens. What that does is that helps me out for day trading. If I'm not day trading, I don't necessarily need 3 screens. 1 screen and my phone is going to be quite enough. I can analyze the charts and enter those orders right there on my phone. So it really depends on what you're wanting to do. Day trading, absolutely, most definitely need extra screens. One reason why I always, when I'm trading here in the office, I like to have the spiders and the cues up on one of my screens at all times. That just helps me understand if there's a big movement in the markets, and that should help me anticipate certain levels I'm looking at for day trades, whether they're going to hit or they're going to miss, or if I can target something else. And the spiders and cues really help me hone in on that. Once I'm in a trade, I'll still monitor the spiders and cues, but then I also have at least 1 screen on the trade I'm in, and then another screen focused on other opportunities that present themselves. But yeah, hey, I feel your pain there. When you're traveling, just do your best to monitor those 2 screens, and then also include your phone, because your phone in essence is another screen too.
Cool. All right. Next question from Vin. Vin saying, could you please TA NEO? Where would you look for a profit target for NEO?
Sure.
And
I am anticipating that you are, that you're already in the trade, correct? So let's take a look at it. All right. So NEO. All right. So what's happened here? We've seen that they've broken above this wedge very nicely. And I like to do a couple things. NEO, you can trade this however you want. Typically, whenever wedges are broken like this, and here I'll zoom back in. When wedges are broken, what typically happens is you have some sort of move up, like a euphoric move up. And then after that's concluded, it hits resistance and then oftentimes comes down and retraces where it just broke out. Now, in this particular angle, it may not get all the way back to the retrace. And so you could, in essence, once price moves up about 10%, and that's what I like to keep it simple when I'm trading, the 10% rule on swing trades, 10 to 20%. Maybe I'm on small caps like a NEO. Maybe you're targeting 20 to 30%. But once you reach that threshold, go ahead, take your profits, then look for another opportunity to get in. You may get a chance that's lower than your initial entry average. So in this scenario, though, I would go ahead and target 10 to 20%. Because there will be resistance and people will take profit, and then price will retreat down lower, giving you an opportunity to get in again if you are interested in this for a longer term move.
Cool. All right. Kelly asks, when you join the live day trading room, how do you know what position to take on each trade? Say on a smaller account of $200,000 to $400,000.
As far as what size position?
Yeah, size positions.
Yeah, okay, all right. Well, it really determines, and we do a great job of this in the room too. We try to give you all the info ahead of time, such as 1/10th position, 1/20th position. But in general, this is a very easy way to understand it. If you have stocks that have a market cap of $10 billion or higher, an average volume of 1 million shares traded per day or higher, you can typically go into those trades with a little bit more of a position. Small caps that are going to be 10 billion and lower, you want to go lighter on those positions. We'll often, whenever we find a setup on a small cap trade, we often leg into the position with 1/20th of our share size for our total position that we're wanting to take. But it's very important to notice the market cap size, because the fluctuations that occur on smaller market caps is much wider of a range than on the higher market caps. Take you can use this for yourself. Take a look at Apple. When's the last time Apple's moved 30% in a day? You know, you're going to really be hard pressed to find that data and find that information. And so usually a stock like Apple, with a much larger market cap, is going to move 2 to 5% as a big move for that stock for the day. So that should help you out in reducing your risk so that you can maximize your reward.
Cool. Great explanation there, Drew. All right, next question comes from the Stock Trading Diaries saying, can we look at the run on BB, Blackberry, I believe, and when is the best time to get in, or when would be a good time to get in?
On a retrace. Yeah, you don't want to be chasing. You know, I'm one of those traders. I never want to chase. We see BB up here right now, and we see it's also already pierced above these pivots over my left shoulder right here. What I would do is I would wait for a sort of retrace. If you're very confident in the move that this stock's going to have, you can see right here we just pierced above this area, came back down and retested this line. This is still too extended for me to buy. I would like to buy if price came back down under $5 on Blackberry, maybe even this area right here. You see this collection area of pivots. And if I go over to this side of the chart, that also corresponds with this area too. This area is going to likely catch price coming back down. But I noted this just a moment ago. All stocks just don't continually go up. They initially may look like they're going to continue up, but they eventually retrace down. And so buying at support will give you a better opportunity to reduce the risk and increase the reward.
Cool. All right. Next question comes from Sia. Sia says, I want to join the live day trading room. Can I use my own brokerage? Can you explain what requirements I need to have before I join? You are great.
Hey, thanks for the preloaded compliment. Always appreciate it. But the main factors you want to have, yes, you can use your own brokerage, but you want to make sure, especially if you're in the United States, there are restrictions for the minimum amount of capital to use for day trading. You have to have at least $25,000 in your account to day trade. After that point, then you do qualify for 4 times leverage for day trading. But keep in mind that leverage is only able to be used during the day. If you exhaust all that leverage, hold it overnight, you will be in a margin call the following day. So it's something that's only designed for day traders. There's a lot of rules, a lot of flags that pop up for folks that don't have accounts at the $25,000 minimum. So say they have a $20,000 account, there's all these warning signs saying don't take more than 3 day trades a week. Your account could get frozen, or you couldn't have the ability to buy more of a particular stock. You don't want to be in that position. It's not necessarily to scare you. What it's trying to do is to make sure that you have the minimum $25,000 requirement, and then that unloads the extra buying power, as I said, with a 4 times buying power to allow you to make more money on those high profitable trades that we do take in the live day trading room.
Cool. All right, next question here from Jamie. Jamie says, SoundHound, the technicals were bullish, but then the NVIDIA news broke and it tanked 30%. What typically happens in this situation, and what would you look for in this situation?
Yes. So SoundHound's one of those stocks that, had a euphoric run. It had a lot of momentum behind it. Usually whenever these stocks come to their exhaustion, a big retrace occurs. And so that's what we're seeing right now. What I'm waiting for on SoundHound, I did notice this big drop. I didn't pull the trigger on a small cap long on this quite yet. I was waiting for more of a retrace, a 786 retrace to be exact. And that's a Fibonacci sequence. That sequence number brings price back down in this area. That's going to be right around $6, $6 to $7. And if you notice, I often like to correlate some of my support levels with previous pivots and previous chop action. That area shows me there's a lot of investors that have gotten into the stock at that level, and they're not going to let it go any lower. More or less, they probably are going to be buying again when price comes to that area. So this big drop, while it was dramatic, notice what we do have happening here. That's a bear flag. And that bear flag pattern does have measured moves. So that tells me this stock may not be done selling yet. So I'm going to sit back patiently. Again, reduce my risk. wait for a level that I really, really like at that 786 Fibonacci retrace, and then potentially enter at that point.
Cool. All right, next question. Tom says, I never see you guys talk about moving averages. Do you guys use them?
Yes, I do. I know. And I do mainly for swing trading plays and longer term plays. One, I actually talked about it this last week with the spiders. So let's look at the spiders and let's see if we even have, I can flip that simple moving average on. Here. There we go. And there, we actually have a myriad of them right here. So with this one laptop, I don't have all of the setup that I normally do with the moving averages. But yes, I most definitely use the moving averages. What the moving averages help me do is they help me understand if price has conviction going in one way or the other. And usually you can also anticipate max movements from standard moving averages from how far they get away from the 20 moving average. Keep in mind, the 20 moving average, depending upon what time frame you're using, is like a retractable dog leash. Usually price should hit that level within 20 of that time interval. So let's just say we've got it on the daily time frame. Within 20 days, that 20 moving average should be tagged. And if it's not tagged every 20 days, it's getting extended too far in either direction. And you can look for a pullback at that time.
All right, next question. Alan says, would I be able to take all the day trades in the Apex live day trading room like the 29 trades closed last week?
Yeah, you absolutely can. That's one of the benefits of being in the live day trading room with us. While all of us are hunting out the best trading setups for you, you're gonna have the opportunity to go ahead and execute those when we're giving you those buy and sell signals straight away. For you to execute 5 or 6 day trades at one time is almost impossible if you're hunting them out and finding them on your own. So take advantage of all the knowledge, the extra eyes that we're providing you with great trade setups. That way you can profit exponentially more than if you were trading on your own.
Okay, next question. Salome says, on a stock like Decker Outdoors, where it crashed through a bunch of support lines, how would you maneuver through a trade like that? Would you keep buying more at each support line, or what would you do? Yeah,
with this one, if you're playing as a day trade, I suppose that's the question.
I think a swing trade.
Okay, so for swing, what every swing trade I do is I ensure that I'm not going 100% on any one of my trades. I don't want to find a level and say, hey, this is it, because levels work for a certain time frame, but then often they break, and every candlestick that we get shows us a different pattern that's taking place on the charts. So in essence with DEC did fall so much. As you see, it paused here and then continued to fall over the following trading days. So DEC is one of those, you're exactly right, that has blown through a couple levels. But if you go into a trade knowing that you could be wrong and that there's other levels that you want to add to, withhold that capital so that you're able to add that capital at the other support lines. Because if you're able to determine support areas, you know that when price does ultimately hit the final support area, a reflex technical bounce will occur, and you want to make sure to have your average right in line so that you can profit when that bounce happens.
Okay, next question. Sampalm says, I'm shorting Meta right now. How high do you think it will go up?
You know what? It's a question no one can accurately answer. Just because stocks can move past our resistance areas and they can go beneath our support areas much further than we anticipate. But we do have several factors showing us right here on the chart that Meta has been exhausted. Whenever we do have a move up on a stock that's very vertical, imagine this like a sprinter running a race. The sprinter's exhausting all this energy to get up to the top, but once they get up to the top, that energy is done. They may have one last blow off top and then a return, and profit takers will start coming in heavier when price comes back down into that parallel. So there is no clear-cut answer. Where is Meta going to stop? It is looking at it. The chart is showing us on several different factors where the high end of this parallel, we're touching this trend line. We're at an extended move. The RSI is off the charts. So we have all these factors showing us a pullback is imminent. However, Euphoria can stay up here longer than you anticipate, so make sure you don't invest all of your capital to expose you to greater risk, but that turn down is likely to come in the near future.
Cool. All right, thank you for that question. Next question, and let me know if you need a breather, Drew. James saying the amount of companies that have had large dumps after earnings seems to be a lot. Is that correct? Why is that?
Well, they're starting to occur more often, and we could just look at the spiders for that. We're right up there near the all-time highs, right? You go to the spiders, whenever the markets are at all-time highs, pushing higher is also more difficult too. So see, we've tried to do this on 3 separate occasions. We now just poked above this last Friday. However, we haven't confirmed above this trend line yet. So whenever stocks are at all-time highs, especially the market, the price for those stocks may be priced to perfection. And so you have a buildup, like a move up on that stock into earnings. And so if the earnings don't meet all the criteria, then investors are going to go ahead and snag those profits and come right back in. So that's why it happens often. It's almost like the run up and the anticipation of those earnings has already occurred. And so the people are wanting to take those profits. And then also sometimes earnings reports may not be as idyllic as some of the investors had envisioned. So that could be a reason why they sell off too.
Cool. All right, guys, we're going to take one final break here to talk a little bit about our smart money commodity service.
Hey folks, welcome to Smart Money Commodities and Miners. This service caters to investors looking to excel in swing trading of both hard and soft commodities, ETFs that track the commodities, and stocks of companies in the commodities sector. This is a technical analysis and data-driven service that avoids the hype with strict discipline, trading levels, and insights. Raise your investing and trading to the institutional level with Smart Money Commodities. Watch the videos below to discover all that is included in Smart Money Commodities and Miners. Hey everybody, welcome back. And listen, from us here at Verified Investing, we thank you guys for tuning in to this Get Smart episode here at verifiedinvesting.com. Thanks for hanging with us. The amazing questions. I think Lawton's going to be giving additional answers to any questions that were unanswered. So look for that. If your question didn't get answered, obviously we only have a limited amount of time. As always, we'll be back tomorrow when the stock market is open with the game plan and trading the close. But as always, folks, focus on the charts, the data, ignore the hype and the narratives. That's the way to success in trading. We'll talk to you soon. Take care.